Okay, guys, I want to go through this Chapter 10 quiz with you. I wiped out all the answers. Many of them were incorrect. So sorry about that. The publisher screwed up, and I didn't go over it myself, which I apologize for. But this is correct. I put the new answers in, and I will try to send it to you if I can save it. However, number one, if a business buys goods, when they buy goods, they're going to debit purchases or merchandise inventory, depending on whether they are in a periodic or perpetual system. Periodic, they debit purchases. Perpetual, they debit merchandise inventory. That said, if a 350 purchase was made, a debit has been made to purchases or merchandise, and a credit has been made to the account payable. So, if you credit accounts payable and then later return a portion of the merchandise from that purchase, you issue a corresponding debit memo, and the seller will acknowledge, or vice versa. There'll be an acknowledgement. The seller will send a credit memo crediting the amount that you owe him, and you'll send a corresponding debit memo, and the debit, of course, is to accounts payable. The debit is to accounts payable. A debit memo actually means we go into the vendor's account and we debit his account to reduce it to $325. That's your answer. Both number 2 and 3 address who pays the freight. Of course, there are freight charges with any sale. Either the seller is going to pay or the buyer is going to pay. And usually the trade terms as established, I think in the UCC, the Uniform Commercial Code, lays down the fact that if the buyer pays the freight, the phrasing should be FOB shipping point. Now, the shipping point is in Chicago, okay? So that the buyer will pay the freight when the when the goods are delivered from Chicago to Lynn. So that if you see the invoice, which will read FOB Chicago, that means the buyer is paying the cost of the merchandise and also title transfers, title to the merchandise transfers at the shipping point, because the buyer is paying for the freight and now owns the merchandise at that point. Okay, so when you read FOB shipping point, it's an indication that the buyer is going to pay the freight. In number 3, FOB destination is a sale where the seller pays the freight. So that this would read I went right to the answer, okay, D, the seller is paying for the freight and the sale takes place. That means title passes when the goods received in Lynn takes place. So the destination is Lynn. So again, the seller pays the freight. When you read FOB destination, the destination from Chicago to Lynn, destination is Lynn, shipping point is Chicago. Okay, so that is the reversal of what took place in converse, I should say. This is the converse of what took place in number 2 takes place in number 3. The opposite is where the seller pays, and again, to the destination, FOB destination, the seller pays for the freight all the way to Lynn. Okay, over here, the buyer paid all the way from Chicago to Lynn. Over here, the sale takes place, which means the title to the goods transfers to the buyer at the point of shipment because of the fact that the buyer pays the shipping cost. Over here, the title does not pass. The goods are still in the hands or the property of the seller, and then title transfers when they are finally delivered, and the seller has paid the UPS or FedEx or the post office or any common carrier. Okay, now we go to number 4, a business form that indicates a department's request to purchase supplies. They're sending over to their purchasing department what is known as a purchase requisition, a form that indicates a department's request to purchase supplies is a requisition to the purchasing department. So that answer is A. And then the form that the department approves based on the requisition that the supplies need to be ordered, then they will issue a purchase order to the supplier of the supplies, to the vendor. So a purchase order is a request to purchase from the vendor. Okay, a purchase requisition is internal from the department itself that needs the supplies, will send to the purchasing department of the organization a purchase requisition, hoping that they will fill it out and then they will fill out the purchase order in order to get the supplies in the house. Number 6, the account used to record the cost of shipping merchandise, the account used to record the cost of is added to the merchandise inventory account when the perpetual inventory system is used. We debit inventory when we buy the stuff, and when we add shipping cost payments, we also debit merchandise inventory. If it were a periodic system, we would debit the other account called freight in. So either answer is correct, but I am making the assumption that we are using the perpetual system that is used, an account and the account purchases would be used in a periodic system. I stand corrected. The account freight in or purchases, but I'll type in FREIGHT because of the reference above. Freight is used in the periodic system. Okay, so that's number 6. The answer is inventory based on this assumption that we use a perpetual system versus the fact that we would use a freight in account, which you see right here, and I typed it in for you. And there you go, is used in a periodic system, but here we're debiting the inventory directly. Company number 7 purchases goods but found they were defective and returned them. The company would record this return. Obviously, it speaks for itself. Kind of a no-brainer, a purchase return. A purchase return, of course, will reduce the inventory cost or reduce the purchases account depending on the inventory system, so that the amount of merchandise has to go down. When you return the merchandise, you're going to be crediting merchandise inventory to record the reduction of inventory. Okay, number 8, purchases discounts are based on the cost of the purchase less any returns and allowances. It's a little tricky here because if there's freight added into the purchase, you do not grant a discount on a freight charge that is added into the cost. Okay, so if there's a $100 purchase and a $5 freight charge, you only will grant the $100 purchase and a $20 return. Okay, and if there's freight of $5, forget about the $5 in freight. You calculate the discount on the $100 minus the $20 return. You'll calculate the discount on $80, notwithstanding the $5 at all. It's completely eliminated from the calculation. We don't grant discounts. No one grants discounts on freight. Okay, so in number 9 here, a buyer here, a business returns goods to the seller. The buyer has to debit the accounts payable account because we are reducing our obligation because of the return. So that if Paul, the buyer, buys from Bob, then I have an account payable to Bob. So not only do I have to reduce accounts payable general ledger, but I also have to go and reduce Bob's account in the subsidiary ledger, who is the supplier to me. So I owe him money. Okay, he's the seller. I'm the buyer. I returned the goods to the seller, whose name was Bob, so that I debit accounts payable Bob and make sure I get that into his individual account in the accounts payable subsidiary ledger. And finally, the term gross profit is widely used in the merchandising business environment, which is the difference between the company's net revenues from sales of merchandise minus the cost of goods sold. So that when we look for an answer here, we see it highlighted immediately. We have to subtract the cost of goods sold from the sales revenue in order to get gross profit on sales. When you look at an income statement, for example, if you went over to Walmart's income statement, you'd see a massive amount of sales, and then you'd see less cost of sales or cost of goods sold. That's the cost of the merchandise that was sold. So it brought us in revenue. And on the income statement, when you prepare it, you take the total revenues, total gross revenues, minus returns and discounts, the contra revenues. So you subtract from the gross revenues, you subtract the contra revenues to get net revenue on net sales, and then subtract the cost of goods sold, sometimes referred to as the cost of sales on financial statements out in the real world. And they'll call this gross profit figure the gross margin. This is what's left after the cost of the merchandise is covered. Then we have this amount, oftentimes expressed as a percentage as well, because it's a key statistic that management uses to guide themselves toward improving profits or degenerating profits. So we look at the profit margins and try to improve them all the time. So to make a longer story short and back to the point, is you calculate gross profit done on the income statement by subtracting the cost of goods sold from the revenue, which would be expressed as net sales. Okay, that's it. I hope this helps you, and please repeat it if you need to. I'm sure a lot of the questions are on the quiz or something thereof. It's a lecture. It's a whole bunch of stuff in one video, which took me 13 minutes. 10-minute quiz. Okay? Thanks. Bye-bye.